Welcome back to our special coverage of the Fed decision. I'm Tyler Matheson, along with Kelly Evans here in Washington. Just a few minutes away now from the release of the Fed's decision on interest rates, about 4 minutes to be precise.
We'll see what our panel is looking for, but let's get a quick check on the market setup before that. You see the Dow hanging on to about a 0.2% gain. The S&P is up 0.4, and the Nasdaq is up 0.6 today. The 10-year note right around on the nose at 4.80. We dipped a little below that this morning after some weaker than expected data, especially that weak ISM manufacturing number. It's very forward-looking. It's very market-sensitive. The ADP employment report was also a little bit light on private sector hiring. That said, the JOLTS report also showed some strength. So anyway, the 10-year note 4.80 as we get ready to hear from the Fed. Let's get to our panel. David Kelly of J.P. Morgan Asset Management, Kristen Bitterly of Citi Global Wealth, Jim Caron of Morgan Stanley Investment Management, and here back on set with us is Paul McCulley, former PIMCO chief economist. Welcome to all of you. David Kelly, what's your take?
Well, I think the Federal Reserve will change as little as possible in this statement. My version of Fed statement bingo is that they upgrade one word with regard to economic strength, and then they just get rid of the clause about how the labour market's weakened. But overall, I think they're looking at an economy that is strong, but it's not necessarily hot. And I think that's really the important point here. There's no evidence that inflation is picking up again here. We do think the economy will slow down a bit in the upcoming quarters. So the Fed pauses here, and frankly, I think they're done. I don't think there's any reason to push rates or their luck any higher here.
All right, Kristen, why don't we hear from you? I assume you think sort of the same. No move today, but door left open for the future. David says they're done. What do you think?
I would agree with David on this. I think that it's going to be a hawkish pause in terms of leaving some of their optionality open. But at the end of the day, when we look at the overall economic data that we're receiving, yes, it's hot, but there's also signs of some cracks and some weakness. The ISM report that we saw earlier this morning. So I think the most interesting part of today is really going to be the press conference and digging into how they're viewing inflation and how they're viewing kind of the trajectory for longer term rates.
Although, Jim Caron, one of the fascinating things about the last meeting was that the chair was his usual kind of hawkish self, and then the minutes came out and were more dovish, and then the beige book came out and was even more dovish.
So, I think the Fed is likely not to do anything at this meeting, but I think that they want to leave the door open for the future. So, look, I mean, the latest run of data that we've had, and I know it's for the third quarter, but it does give us momentum into the fourth quarter. But the third quarter data was pretty strong. So it's really a question of, are things cooling fast enough? Will inflation get down to the levels it needs to get to? So if we look at CPI, headline CPI was still printing, a hot 3.7%. Target core PCE for the Fed is around 2. We're still running above those levels. So the question for me is, do they use this do they use this meeting today to actually suggest that they may hike rates possibly in December? Now, I don't think that they will, but I think there is a risk that the Fed comes out a bit more hawkish just given the recent run of data.
Paul, we got 1 minute. As the Giants proved last week, a lot can happen in 1 minute. Not all of it good. Is this one of those times where doing nothing is actually doing something?
Absolutely. Absolutely. We're at 5 3/8 for the Fed funds rate. The entire yield curve is below that level. So the Fed's tight. And if the data is stronger or the inflation is not as disinflationary as they want, there's room for the marketplace to continue doing the Fed's work. The Fed's in a good place.
And so the Fed chief is probably happy that bond yields are higher.
Yes, yes.
He's quite content with that.
He likes the fact the market's not fighting him anymore.
All right, folks, we're going to have you all stick around as we get ready now for the decision from the Fed. Widely thought that there will be no change. Widely thought that, the door might be left open. Let's go to Steve.